You're weeks away from another passport in your portfolio via citizenship by investment when the government doubles the investment threshold. Are you protected? Or did you just lose a whole lot of time and capital? It depends on one critical threshold. In this video, we'll break down the 3 moments when investment migration rule changes can hurt you, when you're actually safe, and how to protect yourself before it's too late. So let's start with the most basic question. At what stage are you actually protected? Most investment migration programs follow predictable application stages, but protection from rule changes varies significantly based on where you sit in the process. Typical citizenship by investment programs progress through initial application submission, fee payment, full documentation review, approval in principle, investment payment, and final citizenship approval. This process matters. Take, for example, the time when St. Kitts and Nevis doubled the minimum investment threshold overnight. The government confirmed they would process applications submitted before the reform deadline under previous regulations. The same thing happened with the 2024 Pan-Caribbean Agreement. Applications already submitted were grandfathered in. This grandfathering provision illustrates standard practice across the market. If you've paid processing fees and submitted complete applications, you typically receive protection from subsequent rule changes. Earlier stages leave you exposed. Engaging lawyers or paying consultation fees, but not submitting formal applications means you lose these costs when programs close or requirements increase substantially. Industry practitioners have seen this play out repeatedly. Preliminary work becomes worthless when governments announce immediate changes. The key threshold appears to be formal application submission with government processing fees paid. At this point, most jurisdictions honor existing commitments, though the level of legal protection varies by program structure and local administrative law. So that covers what happens before you're approved. But what about after you've already gotten citizenship and you're sitting on a real estate investment, for example? That's where threshold changes become a problem. Caribbean citizenship by investment programs present unique post-citizenship risks for the real estate investors due to mandatory holding periods and resale market dynamics. When governments adjust minimum investment thresholds, existing shareholders face immediate valuation impacts. In March 2024, 4 Caribbean nations signed a memorandum of understanding establishing a $200,000 minimum price floor for citizenship by investment programs. St. Lucia joined just a few months later. This agreement directly affects real estate project values, as shares purchased at previous thresholds may no longer align with new minimum requirements. Real estate investments in those citizenship by investment programs typically require 5 to 7 year holding periods before you can resell the share or the property. During this period, threshold increases create asymmetric risk. Your existing shares remain valued at historical minimums, while new applicants must meet higher thresholds. Conversely, threshold reductions can strand you with overvalued shares that new applicants can acquire more cheaply elsewhere. As immigration lawyers point out, CBI real estate operates in a specialized market where buyer eligibility depends on program requirements. When those requirements change, the pool of potential purchasers shifts accordingly. This dynamic distinguishes CBI real estate from traditional property markets, where regulatory changes affecting buyer qualifications typically have less significant pricing impacts due to larger, more diverse purchaser pools. Now let's look at golden visas, which face different regulatory risks entirely. Golden visa programs are structured as temporary residency pathways rather than direct, immediate citizenship grants. Portugal's elimination of its real estate investment pathway in 2023 demonstrates how policy changes can create closed markets for existing investors. If you held a Portuguese golden visa and invested in real estate before that program's option closure, you now face limited resale options. The specialized nature of golden visa real estate, often purchased specifically for program compliance rather than traditional investment criteria, creates concentrated risk when regulatory pathways close. But Portugal's biggest change is currently in motion as we speak. As the government finalizes its new citizenship law, golden visa holders now face a 10-year naturalization period. That's double the time they initially thought they would have to wait. Portugal's new naturalization law shows that while most legal changes do not apply retroactively, some do, and their effects can be significant. Let's contrast that with Greece. Greece's 2024 increase in golden visa thresholds illustrated a more investor-friendly transition. The government provided protection for investors who had paid deposits before the announcement deadline, allowing them to complete purchases at previous thresholds. These transition provisions matter significantly for program sustainability. However, even these grace periods can have knock-on effects. When Greece announced the policy update and the deadline, investors rushed to get their applications over the line. This created a considerable backlog. Greece then had to implement decentralized processing to tackle a backlog that reached over 40,000 files and processing times that stretched to 18 months. So even if you aren't directly affected by a regulatory change, your application may be. A risk category that most people do not consider is currency exposure and external policy shifts. Bank deposit options and investment migration programs expose you to currency and monetary policy risks beyond direct program regulation. Turkey's termination of its KKM currency protection regime in August 2025 is a perfect example. This shows how external policy changes can affect investment migration participants during mandatory holding periods. If you chose Turkish citizenship by investment bank deposit options, you faced immediate Turkish lira depreciation exposure when the government ended currency guarantees. This risk existed independently of the citizenship program itself. You remained eligible for citizenship, but your underlying assets lost value due to broader economic policy changes. The Turkish example illustrates that investment migration regulatory risk extends beyond program-specific rule changes to encompass macroeconomic policy shifts affecting underlying investment vehicles. Currency exposure represents a category of risk that grandfathering provisions cannot address. It stems from sovereign monetary policy rather than investment migration program administration. So what about donation options? How do they compare? Pure donation-based programs eliminate post-approval investment risk by requiring no ongoing asset exposure. Once you receive citizenship, you face no holding period requirements or resale market risks. However, donation programs carry different pre-approval risks. Governments can increase donation amounts or close programs entirely, affecting you if you haven't yet received final approval. The binary nature of donations creates clearer protection thresholds than graduated investment structures. Recent increases in Caribbean donation thresholds demonstrate that even contribution-based programs face regulatory adjustment pressure. The advantage lies in risk concentration. Once you obtain citizenship, regulatory changes cannot affect your completed donations, unlike real estate or bank deposit investments subject to ongoing market exposure. So the question is, how do you actually protect yourself from all of these risks? Investment migration regulatory risk requires strategic approach selection based on your individual risk tolerance and investment timeline. Timing considerations favor faster processing programs if you're risk averse. Programs with 6-month processing windows provide less exposure to interim rule changes than those requiring 18 to 24 months from application to citizenship. However, you must balance processing speed against due diligence quality and program reputation. Your investment structure selection significantly affects post-approval exposure. Donation options eliminate ongoing regulatory risk, but typically cost more than real estate alternatives. Real estate investments offer potential returns, but create holding period exposure to threshold changes and resale market conditions. Geographic diversification through multiple program applications can provide regulatory risk mitigation, though it requires substantially larger capital deployment. Some investors pursue simultaneous applications in different regions to avoid concentration risk in any single jurisdiction's policy changes. Legal structure optimization can provide additional protection. Certain corporate structures may offer enhanced grandfathering protection, though specific mechanisms vary by jurisdiction and require specialized legal advice. Professional advisory relationships prove crucial during regulatory transitions. Expert guidance helps you navigate these changing regulatory environments. So let me wrap this up with the bottom line. You cannot eliminate investment migration regulatory risk entirely. These programs operate at the discretion of sovereign governments who can change rules whenever political winds shift. Your protection hinges on one critical threshold: formal application submission with government processing fees paid. Before that point, you're vulnerable. After it, most jurisdictions honor their commitments, though legal protections vary. Choose donation programs if you want cleaner exits with no ongoing exposure. Select real estate if you can stomach 5 to 7 year holding periods and accept that threshold changes may affect your resale value. Avoid bank deposits in volatile currencies, unless currency risk fits your broader portfolio strategy. The market's evolution for greater standardization may reduce some forms of regulatory arbitrage, while creating new forms of systematic risk. Your success depends on 3 factors: timing your application strategically, understanding your program's specific protection mechanisms, and finally, maintaining relationships with advisors who monitor both program-specific developments and broader policy trends affecting your underlying investment vehicles. And by the way, you can find experienced investment migration professionals at imidaily.com. Governments will keep changing rules. Your job is to know which changes can hurt you and when you're safe from them. If you're considering a European Golden Visa, there's another risk you need to know about, and it has nothing to do with price hikes or holding periods. Watch the video on your screen. Europe's discrimination machine is coming for you next to find out what's coming. If this video helped you, subscribe and hit like so we can keep making content like this.